Hey guys, and welcome back to Millennial Investing. In today's video, we're talking about the top 4 Vanguard ETFs that I would recommend that you invest in 2022. With the outlook of this bearish market, the potential of a recession coming, there's certainly some thinking that we need to do behind where we put our money. And guys, this isn't financial advice. This is strictly what I would do if I was facing the current market and what I'm doing right now. So these are the top 4, my top 4 picks, the top 4 picks from a lot of people of Vanguard ETFs that you should consider investing in 2022, again, in this bearish market, and let's talk about it. If you guys are new to the channel, I provide free investing, personal finance, and entrepreneurial advice. I'm a seasoned entrepreneur, I'm an engineer, I've been in personal finance for some time, I've been in the YouTube space, in a different space for a long time, and I'm here just to talk personal finance and hopefully allow you guys to retire a little bit early if you implement some of the things that we talk about on this channel. And please, like the video if you get any content out of this. We're a new fledgling YouTube channel. Every like counts, every comment counts, and I'll be sure to talk to you guys in the comment section. So we're talking about extremely low cost. This is low management cost Vanguard ETFs. We want a high level of reliability. We want good history tracking. We want to understand what's been happening in the last decade or longer so we can have verifiable data. We're also looking for a good balance of reward versus risk, especially if you are under the age of 40. I really recommend looking at investments. Again, we're not YOLOing our money into a no-name crypto or even into crypto. I'm just saying if you're looking at index funds or ETFs, go for something that is a little bit more risky for reward. And again, not like a world market here. While world markets are certainly great, there are some that aren't great, and we can see exactly with the conflict that's happening why that would be the case. The US stock market is just as risky, but these 4 have a good balance, and historically they've done really, really well, and they're perfect vehicles for the set it and forget it type of people. And even if you don't want to just set your money and forget it, these are the kinds of things that you can kind of set it and let it go and focus your time on learning other aspects of the stock market, tracking other stocks, doing all your stuff and all your research and all your comparisons elsewhere, while you know this is at least tracking indexes that you can believe in. The first one on our list is going to be VOO, and we're going to jump over to my computer to look at the stats and data of VOO. This is a stock that I regularly invest in. I buy this every single day, obviously with not a lot of money because I'm not some secret multimillionaire, but I'm buying VOO on a regular basis. Let me show you why. So this is the Vanguard VOO. It tracks the S&P 500, which is the top 500 traded companies in the United States. The first thing that I want to look at, and one of the beautiful things about the S&P 500, is if you invested $10,000 in 2012, what would you have in 2020? Even with where the market's coming down, you'd have $38,903.56. So your money has, if we took this a little bit, a couple weeks ago, the idea is right here, the S&P 500 has quadrupled in price in the last 4 years. Absolutely incredible. Probably not going to happen again, but you can see why you would want to invest in the S&P 500. We go down a little bit more. It shows you a breakdown of the technology spaces that it's in. I actually don't care as much about the equity sector diversification. I look more at who is part of that grouping. Now, obviously, the S&P 500 is very tech heavy. Tech nowadays is a very broad term because tech is in all of these older, I like to call them old world diversifications. Tech kind of embodies a lot of them. But the reality is it's Apple, Microsoft, Alphabet, which is Google, Amazon, Tesla, Nvidia, Berkshire, Meta, United Health Group, Johnson & Johnson, the list goes on. These are all very, very large companies that are doing very, very well, and over the next 20, 30 years are going to be doing extremely well. So let's look at price and performance for a second, and we're not going to spend as much time with the other 4 as we are this one. I just kind of wanted to show you and give you guys an idea. What's important to see here actually is if we go down and we look at the average annual returns that are updated monthly. So if we look over 10 years or since inception, which is in 2010, we can see that the S&P 500 ETF, which is VOO, has averaged in the last 10 years about 14.54% return. The average stock market return has been 10%. That has been the historic average that everybody uses. And since inception, it's been 15.08%. The 3-year you can see is 18.815. Obviously, the past 2 years has been really good for the S&P 500. But I guess what you can see is that this is outperforming the stock market. Now, Vanguard does say that this is a 4 out of 5 on their risk level. What does that mean? 1 is their least risk, and 5 is their most risk. So a 4 is upwards on their risk potential. But honestly, as things go, as investing goes, as you open your Robinhood and you want to put money away and invest, a index fund or an ETF that tracks the S&P 500 is as safe as it gets, unless you want to bundle in bonds and things like that, which if you're under 40, I honestly believe that you don't want to even consider that. If you want to diversify, get into real estate or get into, well, not bonds. You're just not going to see the return that you used to, and it's not going to protect you in the way that you need to do. If you want to retire early and do all those things, these are things you have to consider. Number 2 on our list is going to be VTI, which is a Vanguard ETF that tracks the total stock market. So it does everything that VOO just did, except instead of tracking the top 500 most publicly traded companies in the United States, it tracks the entire US stock market. Instead of looking at all the facts on this because it tracks the total stock market, let's just jump over. Well, actually, what happens if you were to put $10,000 into it? Where would it be now? It would be at $37,806.78. So again, you guys can see that it's gotten pretty good returns. We're almost at a 4x in the last 10 years. And if we jump over to the price and performance, in the last 10 years, it has returned 14.21%. That is tracking the total stock market. Since inception, which was 2001, it's done 8.5%, which means it's averaged that through the housing crisis and what happened there, which is just incredible if you think about the returns. This is a much safer bet than VOO, which tracks the total stock market, but it has less upside, even though we're seeing these higher percentages that are beating the average stock market return. I have pretty strong conviction that money is getting much larger in the upper echelon of companies. Thinking about Google, Amazon, Microsoft, Apple, Nvidia, all that technology is being very much concentrated to certain companies. So I think over the long term, I have pretty high conviction that the S&P 500 or those specific companies are going to return better than the total stock market, because I think things are starting to get a little bit unbalanced, and that's just because certain companies have the money to pursue certain technologies, and that's just going to get faster and more proportionally different as time goes by. The next Vanguard ETF, which I actually love this one, but this is a much higher risk to reward, is VGT. And again, guys, these can all be found on Robinhood, Webull, on whatever brokerage are. These are all publicly available ETFs. VGT tracks information technology, tracks tech. And I really like this one because, again, I have huge conviction in tech. Even though tech has done really well, and probably over the next 2 years, at least from a stock market perspective, tech isn't going to do as well. So be aware of that. I'm not trying to promise you guys crazy returns. This isn't financial advice. This is just what I would do and what I believe. But tech is going to do well in the next 20 years. So if you're set it and forget it, this is something you should consider. But in the short term, this is going to have the highest volatility. So VGT has a slightly higher expense ratio of 0.1, something you should be aware of. Even Vanguard says it's a 5. It's a 5 on their risk assessment. If you were to put $10,000 in 2012, this is where it gets beautiful. It would be worth $63,918 today. If we went before the market went down, it would have been $72,000. So this has potentially 7x your money if you invested $10,000. So if you invested $1,000 in it 10 years ago, you'd have $7,000. Pretty ridiculous. Some of the companies that are in here, the 10 largest holdings, which represent almost 60% of the total net assets, is Apple, Microsoft, Nvidia, Visa, MasterCard, Broadcom, Cisco, Adobe, Salesforce, Advanced Micro Devices. You can tell it's a bundle of a lot of tech and information technology. The most beautiful part about this is the return to date. So since inception in 2004, it's returned 13.14%, which made it through the housing market crisis. But the 10-year average is 20.37%. The average stock market return is typically known to be 10% on a good year pre-inflation. This has returned over the last 20 years. Over the last 10 years, over the last 10 years, this has returned 20.37%, which is absolutely insane. Past 3 years, obviously higher because we've done really well in the past 3 years. But this is something to consider. Again, in the short term, high volatility, high risk. In the long term, you're pretty protected because you're bundling quite a few companies. You have a better chance of doing okay. Now, the last one that I'm going to recommend to you is not a total world stock market, because I just don't believe that that is as safe for the upside of reward, meaning I think the risk to reward ratio personally, and from all the research that I've done and what I've seen in the world and historically, isn't worth it. I mean, the conflict that's happening in Europe right now is the perfect example of where a total world market or a European market ETF might crash. You know, understanding that we are in the US stock market, well, if I had $1 billion, I'd spread it out because I want to preserve some of my wealth. The reality is, for most Americans, like not even just the 1%, the 99.9%, right? It's only the 0.1% that don't feel this, is if the US stock market were to crash 70, 80, 90%, we'd all be just screwed. You know, I mean, that's just the reality. So I'm hedging against the fact that even if that happens, it's not something we can get out of. We won't climb out of it, which is a terrifying statement and which we won't talk about now. But the reality is I'm going to invest in the US stock market. So my last one on this list is VNQ, which is a Vanguard real estate ETF. Now this is an interesting one. Real estate typically is something that I would always recommend to invest in physically yourself. Even if you don't know the market, there's some pretty kind of there are some formulas that basically prove that you're going to make money over the long term. If you look at a 20-year stature, you follow a formula, you meet a certain cap on cap rate, a certain cash flow, you're going to make money on real estate. It is what it is. The problem with that, though, is you need to have quite a lot of money to get into that and make that rate work and make those numbers work and some time. So if you don't have a ton of money and you don't want to do that, the first step is just getting into the space and diversifying a little bit. So if you've got, let's say right now, 100% of your stock portfolio is in stocks, you might want to diversify a little bit and get into the housing market or into real estate. Or if you wanted to get into bonds or crypto, I would just recommend doing a little bit of diversification just to increase your, kind of your stretch and your reach. So in this instance, this is a pretty safe, nothing's safe in this world, but this is an option, is VNQ. Now VNQ has a higher expense ratio. It's a 4 out of 5 on Vanguard's risk assessment. If you were to have invested $10,000 in 2012, right now you'd be sitting at $24,938. Before it would have been $28,000. So you would have more than 2 extra money, which is still amazing. I know we've looked at some really high ones that have done really well. This is still incredible. Let's look at the returns. These are much more market-oriented returns. We're looking at since inception from 2004, we're 8.92%, 10 years 9.56%, and obviously it's done really well in the last year. There are many different advantages to investing in a real estate ETF, but the reality is it's hard money, meaning that money is invested into physical assets in a way that isn't necessarily true with stocks, but the reality is it's going to be such a small amount of money for you that it doesn't really matter, but different conversation. The reality is this will just give you a different tracking. So a great example is if we end up going into the recession that many financial institutions are saying are over 50% probability in the next year, the reality is the housing market probably won't track the recession. It's probably going to be a stock market recession because the housing market has such low demand right now, and people are looking for housing, and it's so inflated, and inflation and wood costs, and there aren't enough homes. The housing market will actually probably survive through this recession and stay rather high. So if you're invested in this real estate ETF, for example, that might actually stay. And if we had a recession and let's say everybody went down 30%, the rest of your portfolio might go down 30%, but your real estate ETF would be less likely to fall. It may still fall, but it won't fall as hard. So that's a very anecdotal, that applies right now in 2022, why you might be in a real estate ETF. Just one example. Again, this is not financial advice, but guys, these are the top 4, maybe my top 4, but I truly think these are the top 4 Vanguard ETFs that you could invest in, that I would recommend investing in, again, for entertainment purposes. And these are going to be the best balance for risk and reward, in my opinion. And these are 4 ETFs that I am investing in a weekly basis and dollar cost averaging as much as I can. Thank you guys for watching. If you enjoyed the video, leave me a like, leave me a comment. I'd love to talk in the comment section below. Hear more about your stories and what you guys are trying to do. I'm trying to retire in the next 7 years. Yes, it sounds crazy, but I'm hoping to retire in the next 7 years, and I'm going to document that entire journey in this channel and through these videos. So thanks for watching, guys. Appreciate it.